welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Erik Kobayashi-Solomon. Erik is a 20-year veteran of investment banking, hedge funds, and the third-party analysis industry. He's also the co-founder of IOI Investor Services, a company that helps institutional and individual investors close the gap between their investment responsibility and their skill set. Today we're going to be discussing his book, The Intelligent Options Investor. Erik brings a value investor's mindset to options. Let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Erik Kobayashi-Solomon, author of The Intelligent Options Investor. Erik, thanks so much for taking the time to be with us today.
Jake, thanks a lot. It's my pleasure.
So let's jump right in. Question number one. One of the things that was really impressive to me in your book was the section on valuation, which just basic business valuation. And I think maybe because you were talking about options in general, otherwise you had to sort of condense down what you wanted to say about valuation. When what ended up, I thought, was really just kind of a diamond gem, couple of chapters that did a great job of consolidating down I think some of the best thinking on valuation. So I don't know. I'm not sure if that was your goal when you sat down to write the book, but that definitely was one of my takeaways.
Well, first, thanks for the compliment. I really appreciate that. And I did work really hard on that valuation bit and tried to incorporate kind of the elements of process. I think that process is so important in valuation. A lot of people, when they're learning how to value a company, they're I call it the salad bar method. So they read a little something over here and they say, oh yeah, that sounds good. And they read something over here. Oh, that sounds good too. Those two things may be completely at odds with each other, but it resonates with them, and so they run with it. Well, that's not a process, and it's not, in fact, a sensible way to invest in a company.
Could you briefly walk us through your process?
Yeah, so my underlying assumption is simply that the value of a company is the sum total of cash flows that's going to accrue to the owners over time. And if you agree with that premise, there's really very few things that can affect the value of the company. A company has to generate revenue, so it has to respond to a demand environment. That's the first thing. Then it's got to convert those revenues into profits. It has to spend less to provide whatever it's providing than it gathers in revenues. And then it's got to invest those profits to be able to grow in the future. And so if we just focus in on those 3 steps and then on the kind of step of growing in the future part, then we can really understand and pull apart the value of a company in a much more transparent way. So I started doing training sessions and under the Intelligent Option Investor name, and people who went through the training session said, I'm really a lot more interested in the valuation than in the options. And so I understand, once you understand the value, then it's just a matter of which tool you want to use, and options are one tool.
That's a great segue for question number 2, which was that I have to confess that I, as a basically long only, value investor, had always kind of viewed options in a boy, those could be dangerous. And I was like, I just had a fear about it. And maybe I think that fear was from a lack of understanding, just like probably a lot of human fears come from. We fear what we don't know. So why was I wrong to be fearful, and why are options a potentially good tool to use if you are of a value-oriented investor?
Okay, so this is a question that I love because I've got a joke that goes with this question.
Perfect.
So I lived in New Jersey for a long time, and once when I was in New Jersey has a lot of traffic circles. And once when I was driving through a traffic circle, I saw a guy that was backing up in the traffic circle because he missed his drop-off point, right?
Yeah.
And it must not have occurred to him that it's a circle, so he just keeps going around the thing. So hating options because people use them in foolish ways is like hating cars because people drive like fools in New Jersey sometimes.
Yeah.
So the thing is if you invest in a stock, you're investing in a derivative. Because in fact, what I'm buying when I'm buying a stock is I'm buying an ownership stake in the company. I'm really buying the cash flows of that company. And so the stock is a derivative of that company's cash flows, right?
Right.
So an option is just another way to get some access to those cash flows. And one of the reasons that options are looked down by people or are feared by people is the people that are talking about options are talking about stupid stuff or stuff that doesn't seem to apply to a value investor or a fundamental investor's kind of strategy. You either get a professor who is writing equations and talking about math, or you get the guy with the cool ponytail and he's saying, yeah, iron condor, or, talking about these like really short-term trades. Yeah, this one expires in a month or whatever. So for a value investor, neither of those groups of people who are talking about options appeals to the way they do things.
Right.
The fact is, with options, it's just another range of exposure, and that's the way I like to talk about options. When you buy a stock, you're immediately exposed to two ranges of exposure. If the stock goes up, you're exposed to that gain, right? Mm-hmm. But if the stock goes down, then you accept the loss. And so all options do is allow you to split that gain and the loss and just figure out which part, whether you want to gain downside exposure, gain upside exposure. So it's a directional instrument that can be used exactly in the way that people use stocks for.
So would you say then that that almost just buying long only is kind of using a chainsaw, and then options allow you to be more scalpel-like?
Yeah, the way I say it, and I've got this in a presentation too, using stocks is really like buying an off-the-rack suit. Like, if you like the jacket, you've got to take the pants too, right?
Yeah.
Whereas options, it's more like you can buy a blazer and slacks. And then you can decide, okay, do I want to wear the blazer today, or do I want to wear the blazer with jeans, or just whatever, right? So it really allows you a lot more kind of control about how you are trying to generate returns.
Yeah. So question number 3, assuming that you have your analysis right, you think something is undervalued, why might options be a better way of expressing that, aside from what we just covered of, maybe you don't want that downside, but and maybe also talk about the element of timing that gets introduced when you choose to segment out your exposure?
Yeah, those are all really good questions. And I've got to confess that I am not an only options guy. I look at options as just like one tool in a toolbox.
Yeah.
And the way I like to think about investing and the way I talk about investing in our training courses and so forth is to look at investing like a meal. And so the meat and potatoes part of the meal is going to be your ownership stake in the company. That's your stocks, your stock. And then options can be layered on to those meat and potatoes to kind of provide, let's say, sauce or like a
little bit of
side
flavor.
dish. Right, yeah. So it adds flavor and interest. But the main part of your meal is still the stocks. And in fact, you can also, you don't want to just eat meat and potatoes, but you want a little dessert. So options are a great way to get a little dessert too. Like I know everybody in their portfolio has like a flyer.
Of course, yeah. You have that you have to scratch that little gambler itch.
Right, yeah. Exactly. And so this is one thing that options are really good at. It allows you to make kind of allocate a very small amount of capital to one of these kind of speculative bets. That's not necessarily a main part of the investing. Options, there was a paper a few years out by the guys at AQR called Buffett's Alpha.
Mm-hmm.
And what it did was decompose Buffett's returns into kind of the components of it. And what this paper determined was Buffett is successful because of two main things. One, he picks stocks that have low valuation uncertainty.
Yeah, the
and
blue
two,
chip.
Right, blue chip stocks. And then he adds leverage to them. And he adds leverage through his insurance company.
Right, the float of the insurance is and I think in that paper, if I remember right, I think it added something like 10% to the total book value compounding
exactly.
of Berkshire.
And so when that paper came out, like all the hedgies that I knew, they said, well, great, okay, this is how Buffett does it, but I can't go out and buy an insurance company just to replicate this strategy.
I think actually a lot of them have tried that with reinsurance, actually.
Yes, well, right, yeah.
But yeah, not to derail
you. One thing that you can do is, in fact, use options. And you can use options to tailor your leverage level. And so a lot of people, and this goes back to your earlier question about why, I just have this impression of options equal fear, right?
Mm-hmm.
I think that what people are really fearing is not the options, but not being able to understand leverage. And leverage is a scary thing if you don't understand it. I think Munger had a great quote saying, maybe it was Buffett, saying, leverage plus stupid people brings unhappiness or something like that. And so our approach is to use just a moderate amount of leverage and understand what leverage is, understand how to measure it and how to manage it, and then in appropriate situations to add a moderate amount of leverage to the investment. And so, that stock that returned 10% last year, with a little leverage, it would have returned 12%, 20% more. So, okay, is 12% a big deal? It's not betting the farm. You're not trying to make a home run on each time, but it gives you that little extra boost.
Yeah. So how about the timing element of options and getting comfortable with the duration risk, or maybe that's not the right term, but that trade, the tenor, I guess, is what you would call the timing.
Yeah. So, and this actually goes back to a question of leverage. Highly levered options are options that are what are called out of the money. In other words, the stock price is 50 and the option only kicks in at 70, let's say.
Yeah.
The leverage on something like that is very high, and the criticality of the timing is also very high. Because if the stock goes from 50 to 68 before expiration, you get nothing if you're struck at 70, right?
Right.
So this is another great thing about reducing the leverage. If instead you put up some of your own capital and you say, I'm going to buy a call option struck at $40 on this company that is trading at 50, you're putting $10 of your own capital at risk. But when you buy a stock, you're putting $10 of capital at risk, or more. You're putting 50 at risk, right?
Right.
So, and by doing that, if the stock goes up to 68, you've made a lot of money. You've made the difference between 40 and 68.
Right.
And so you don't have that time criticality.
You've pushed the returns, though, on either the upside and the downside, both away into more extreme.
Right, yeah. And so what we're trying to do is not be greedy, or be appropriately greedy.
Yeah.
So, and back to your question about valuation methodology, the valuations that we do have different scenarios, and we look at a valuation range, not a point estimate.
Yeah.
And so what we're able to do is compare the range of values to the price and say, even the worst case valuation is about what the stock is trading for now. So I have really limited downside on this. So this is the time to increase the leverage a little bit. And at the end of the day, what any investor is doing is putting capital at risk.
Sure.
And so we're just trying to do this in an intelligent way.
Right. So question number 4, if you are a doubter of the efficient market hypothesis, why should you potentially be even more attracted to utilizing options?
So that's a great question. And I write about the efficient market hypothesis in the book. So let me explain it by something that Richard Thaler said. He broke down the efficient market hypothesis into 2 bets. And one bet is the price is right. That means assets are always efficiently priced. Mm-hmm. And the other part is there's no free lunch. And that means it's really hard to beat an index. Mm-hmm. So in Thaler's view, and also in my view, the price is right condition is certainly wrong. You can certainly sometimes find assets that are severely mispriced.
Right.
However, no free lunch is usually right because it really is hard to beat an index.
Yeah.
And so what I write about and what I teach about is the portfolio management aspect is for somebody who has equity exposure. And right now I'm not talking about bond exposure because you can do something with options to generate revenues and generate incomes. But just thinking about growth, like a growth portfolio. So what we talk about is setting aside most of the allocation to basically bet that Thaler's right, that there's no free lunch. So most of the equity allocation is to equity as an asset class through the cheapest S&P ETF or index fund that you can find.
Right.
And then part of your allocation is to these more concentrated positions. And here's Buffett said, if you've got 6 positions in your portfolio, you don't need to buy a 7th one.
Yeah, you probably have at 6 maybe 85% of the systemic risk already covered.
Yeah. And I mean just from the standpoint of like human intelligence, honestly, it's very hard to keep the details of more than 6 companies firmly in mind and to really, like, if you look at investment as an ownership
one insight is it feels magical. I mean, the idea that you could have 20 or 30 at a time is kind of a tall order.
Yeah. And this is a thing that I think a lot of individual investors really misunderstand, is that there's something about volume of ideas that's important. But like, in fact, if you think about investment as an ownership stake in a company, you want to understand how that company is actually operating and understand, are they doing the right things? Can I measure what they're doing? And can I make some assumptions about what they'll do in the future? Am I right about what I'm thinking? And you can tell that Buffett does this too. He's saying, all right, this company is generating $10 billion worth of what he calls shareholder earnings, what I would call owner's cash profit. $10 billion of that right now. And in 10 years, it's probably going to be generating closer to 25. Do I want to own a part of that business? Well, yes. So for the smaller part of an allocation, or the smaller part of that growth portfolio, to allocate to a few good ideas that you really understand well. And those are the allocations that we may use some leverage on. And just personally, I have three investments right now that are in that slice, and everything else is in an index. And so I can enjoy the index gains, and I also have a real ownership stake in these companies.
So those might be a good segue for question number 5, which is, what are leaps, and how are they a potentially good way for a value investor like myself to dip your toe in the water?
Yeah, in fact, LEAP stands for long-term equity appreciation securities. And all it is a long tenor option, tenor being the time before expiration. So right now you can get LEAPs out to January of 2019. Mm-hmm. So that's a pretty long time horizon for a lot of investors. And if you combine those LEAPs along with the in-the-money options, and here I'm just talking about buying options. You can sell options as well, and there's kind of a different strategy for that. But if you're talking about buying options and you're talking about reducing that like time criticality that you mentioned,
right?
LEAPs are a great way to do that.
So I think you can kind of make the argument that it fits in with Benjamin Graham's original selling message, which was either 2 years or 50% up.
Right. Yeah.
So you're basically buying yourself 2 years on a leap right now, and that gets you almost to what Benjamin Graham had kind of ascribed, just for long only.
Yeah, and going back to that image of investing as a meal, so I'll have the steak and potatoes part is going to be the underlying instrument, and then I'm going to be layering in-the-money leaps on top of that to help get some extra. That's the leverage component, the Buffett's alpha kind of component. And I had a portfolio manager who said, look, if you're not right in 2 years, you might not be right.
Yeah.
And so certainly within 2 years, you can say at the beginning of the time, and this is the other thing that I think is really critical, as you own an investment, to keep going back to your original mental process. Why did I buy this? What did I expect when I bought it? In those few key areas: revenue growth, profitability, investment level, and kind of the prospect for medium-term growth. So go back regularly and take a look at that. And within 2 years, if the company is doing what, that's a good time to increase the size or the intensity of that investment.
Yeah, exactly. So just kind of a follow-up on that question, how do I get comfortable knowing I'm paying the right price for an option, given the trade-offs between the premium that I'm paying and the tenor and the strike price? Because it seems to me like it might take decades of really understanding pricing of options to feel comfortable that, yeah, okay, this is definitely mispriced, or no, I'm actually overpaying for this exposure.
Okay, I'm really glad you asked that question, because everybody has the concept that option pricing is really difficult. But I am convinced, and I've done this, I can teach a 50-year-old housewife from Des Moines, enough about option pricing in 15 minutes that she'll be able to answer questions that somebody with a newly minted master's in financial engineering from like NYU wouldn't be able to answer. In fact, option pricing is a pretty simple model. And I think that a lot of investors, a lot of value investors, get caught up with like the mathematical difficulties of option pricing, where in fact option pricing is pretty sensible. And if you understand a few things, it's very easy to gauge whether or not this price is reasonable. And mainly what we're looking at, I'm not trying to arb very small differences. I'm not trying to be an arbitrage player, in other words. Mm-hmm. what I'm looking for is when the value of the stock is up here, the valuation range is up here somewhere, and the price is down here. So in a case like that, these call options, which represent the upside, are certainly undervalued. And the put options, which represent the downside, are certainly overvalued. So you can decide at that point, do I want to structure this as selling puts? In other words, promising to buy the stock if it goes down. You know the valuation range is up here. So do you want to sell the puts? Or do you want exposure to that upside potential? You'll know that the put options are too pricey. So you want to sell the too pricey things. And you know that the call options are too cheap. So you want to buy the too cheap things.
Yeah. I do like the idea that if you don't believe in the efficient market and you think that prices are sometimes wrong, then thinking about the prices of those prices being wrong, adding a whole nother element of fear and greed out and uncertainty to the whole equation of the not only the business's price, but the price of that business further down the line. That's very intriguing to me.
Yeah, and honestly, I really do think, and on my website, there's some diagrams of these ranges of exposures. I really think of things in terms of range of exposure. And so if I see that there's some range that I want some exposure to, and I can see that the option market is inappropriately pricing that range, then I'm happy. I'll pay the money because I know that range is undervalued in that case.
Right.
And it's not just a matter of like blindly throwing money at it. You have to kind of understand how to structure the investment in a sensible way. This goes back, options expire. So how do I sensibly pick a tenor or something? How do I sensibly pick a strike price? But basically, if you understand that a certain range is undervalued by the market, then it's really easy to invest.
So, bonus question we always ask, and this is for a book recommendation. What do you have for us?
So, in fact, we're recording this pretty soon after the new year, and I sent all our clients a copy of a book called Lessons of History. Mm-hmm. And this is by a couple, Will and Ariel Durant. And so first thing I'll say is that it's short. Mm-hmm. And so for somebody, I can tell just by looking behind you that you read a lot, but a lot of people don't have a lot of time to read, but this is a really short book. Ray Dalio has said that it's his favorite book, that everyone should read that book. That's another thing. Mm-hmm. And the third thing about it that's so cool, Will and Ariel Durant actually wrote a 13-volume history of human civilization. And what this book, which is 150 pages or so, was to try to distill the patterns that they found time and time again in history into a short thing. So, they wrote it in the 60s, and so some parts of it are kind of not, like it's not politically correct in certain ways. It would really anger liberals and conservatives alike. It has...
Yeah, but, as norms have changed.
Yeah, as norms have changed. But honestly, it's a really thought-provoking and really interesting kind of like meta view of history.
Yeah, the cycles that they identify I found to be really fascinating. Just oh my God, there's really nothing new under the sun. We just repeat and play out the same stories over and over again.
Yeah, I mean, in fact, this whole kind of the shift towards populism that we're seeing in Europe and the United States now, I mean, that's talked about in the book. This is the way societies work.
Yeah. Well, Erik, it's absolutely fascinating chatting with you today. Thank you for coming on.
Jake, thanks a lot. It's been my pleasure.
Thanks for watching. I hope you enjoyed this interview. If you'd like to support this author and purchase their book, click here. If you'd like to become a subscriber to 5GQ, click here. And I included a couple other interviews that you might appreciate right here. Thanks. Happy reading.